Hello and a warm welcome to this week's edition of Econoday Unplugged. It's Tuesday, the 9th of November 2021. Terry Sheehan is on the US East Coast and I'm Jeremy Hawkins in London. Well, I suppose these days financial markets tend to take central bank transparency for granted. Investors like being forewarned of prospective policy changes, as it allows them to be appropriately positioned before the actual move takes place. And central banks favour it as a way of helping to smooth out potential asset price volatility. However, last week showed that such an approach can backfire badly when it goes wrong. On Wednesday, the Fed duly confirmed that it would be tapering its QE program, just as the markets had already been guided to anticipate. However, a day later, the Bank of England, very surprisingly, announced no change to its stance, despite having seemingly just instructed the markets to expect what would be the first hike in bank rate in more than 2 years. How much damage this has done to the credibility of the latter's communication strategy remains to be seen. But while investors may be willing to have faith in what the US central bank has to say about its policy intentions, the Bank of England could now find itself struggling as markets contemplate whether to trust it or not. On which note, let's firstly go to the US and the central bank that got its message right. Terry, was there anything in last week's FOMC statement that actually came as a surprise to anyone?
Very little. The language that was related to inflation included some specificity that they don't normally get into about the supply chain and its impact on inflation. Mm-hmm. So I think they are trying to emphasize the nature of the transitory influence on inflation. The other thing was that when they announced the taper in asset purchases, they gave very specific amounts for November and December, but they didn't for January going forward. So they did say that, they could change the pace of purchases. So that means if, the economy slows down or there is some disruption in financial markets, they could slow the pace of asset purchases again. Or they could slow the taper of the purchases again, or they could speed up the tapering. So if the economy is strong and things are going well, they may decide to end it sooner, especially if they think that they're going to need to lift interest rates sooner because they don't want to link those two things.
So it is very keen, sort of dual policy then. Interest rates is one side of a policy, and quantitative for easing, or indeed absence what will be ultimately quantitative for easing, is very much a different aspect to the policy.
Yes, they've been very careful to say that there is a much more stringent standard for liftoff for interest rates.
Do you think they would prefer to be able to put forward, if you like, a fixed amount of tapering every month? Or if we just look across to my part of the world and European Central Bank on their PEP, their emergency purchase pandemic program, within that, the PEP effectively has an overall ceiling on it. But how much they actually spend on any week or any particular month is really down to them and according to market conditions. Do you think the Fed's trying to some extent go down that kind of route by not specifying precise amounts for next year?
No, I think they're trying to hedge their bets about what the economy's doing. The third quarter came in with 2% GDP growth, which was a considerable slowing from the prior quarters. But they need to be sure that, that the fourth quarter at least maintains that pace. So I think they're just trying to signal that the taper will continue, but that they will adjust it, or maybe, as Lagarde said, calibrate it to the current conditions.
Okay, fair enough. Right, you mentioned fourth quarter, so let's have a look at that then. Where are we? Last Friday, obviously, US employment report looked to be a strong number and decent revisions as well. So presumably, is this consistent with the latest Fed tapering policy, or are some bits and pieces in there which might make you a little bit cautious?
Well, it was actually overall a very strong report. October's the first month of the fourth quarter, a 531,000 gain. So that's pretty much on track with what's been seen earlier in the year. It suggests that we are getting closer to maximum employment, however the Fed defines that. There was steady gains in wages, not only at the lower end, but also at the upper end. This suggests that consumers are going to continue to spend. The unemployment rate ticked down 0.2 to 4.6% in October. This shows, and it was due to both fewer unemployed and more people in the labor market. So people are going back to work. So there's a lot of really good news there, which suggests that the fourth quarter is going to chug along quite nicely.
Is it fair to say that, I mean, the participation rate at the moment remains disappointingly low, and this could have implications for potential growth of supply, and ultimately, if demand remains strong, ultimately, lead to continued pressure on inflation?
Well, I think there's certainly concern that the participation rate remains so low at 61.6%. But there are demographic changes happening here. A lot of people retired during the pandemic, and many of those people will stay out of the workforce going forward. Families have readjusted their living situations, and there may be more stay-at-home parents than there were prior to the pandemic. And the other thing is a lot of people are starting their own businesses. So those people are also staying out of the labor force.
All right, fair enough. Interested to hear what pans out there. That's kind of on the real side. Let's have a quick talk about inflation. A couple of things struck me. Yesterday, New York Fed, their 1 year ahead measure of consumer inflation expectations hit a new record high. And of course, this week we'll get updates on the PPI and the CPI. In a nutshell, what's going on there?
Well, it just looks like that the sources of transitory inflation are going to linger longer than they were originally anticipated. And, if the supply chains do not improve, it's going to remain a factor. There is some hints that the upward pressure in prices is easing. This morning we got the PPI, and it was about as expected, but it was mostly due to energy costs. So the increase there is in one of those commodities that tends to be quite volatile. It's something the Fed's going to keep an eye on and worry about, because if this doesn't get better soon, they're going to have a harder time making the case that this will work its way through the data.
Okay, let me ask this sort of a question. In terms of just going back to the Fed for a moment, in terms of tapering, you said obviously that they kind of know the rest of this year, but we don't know yet too much about next year. Where do you think the risks lie? Do you think it's more likely that we could end up seeing a slower pace of tapering, or we see a faster pace of tapering, and kind of what markets are expecting at the moment?
Well, I really want to see the summary of economic projections in December from that FOMC meeting. But I think at this point, based on comments from Fed officials, that they may actually have to accelerate the pace of the taper in order to not link it to liftoff for interest rates, because if inflation lingers more and if we are getting closer to maximum employment, they're going to have to look at lifting interest rates.
All right, fair enough. And let's quickly end up on, if I can do, a little bit of fiscal policy. House of Representatives just approved Joe Biden's infrastructure bill. Where do we stand on his Build Back Better plan, though?
Well, it's one of those things that, now it needs to get through the Senate. But it is victory for him in the sense that he did get something through the House with some Republican support. And I think at the heart of it, infrastructure spending is relatively popular here. So I think some of that at least is going to make it into the US economy.
Okay, I'm assuming improve the chances then of Fed tapering, or ultimately interest rates further down the road. Okay, anything else from your side, Terry?
No, we had a member of the Fed Board of Governors resign this week, or announce his resignation. Randall Quarles, who was until recently vice chair of supervision, said he's retiring at the end of December. So effectively, we have 2 vacancies on the Fed right now to look at, and we're very likely to have a third by the end of January when Vice Chair Richard Clarida's term as governor ends. So I think we're going to see a lot of changes at the top at the Fed.
Okay, something very much to keep an eye on for next year. Great, excellent. Thanks for that, Terry. Let's come across Central Bank of England. So my side of the pond, which really did itself no favours at all by not raising interest rates last week, despite having, to all intents and purposes, told the market to expect a tightening. And in fact, on paper, the vote in terms of an interest rate hike wasn't even particularly close. It came in at just 7-2, with only the recognised hawks, Michael Saunders, and one of the deputy governors, Dave Ramsden, calling for a 15 basis point increase in bank rate, which would have taken it to 0.25%. Now, notably lacking from that pair was Governor Andrew Bailey, whose recent comments had in what many ways been instrumental in convincing speculators that interest rates were on the way up. There was no change in quantitative easing. The margin there was a little bit closer. That was at 6-3, with Catherine Mann joining the dissenters in favour of an immediate end to the quantitative easing programme. But since that's going to be reached by around about mid to the latter half of December, that doesn't really make that much difference anyway. Now, Chief Economist Hugh Pill said that the overall decision was actually a knife edge, but for those sterling investors who've been looking for interest rates to move higher, and indeed, as far as financial markets were concerned, they were 100% nailed on for an interest rate hike last week, and indeed another increase was widely discounted before the end of the year too. They were not at all happy, and sterling lost the best part of a couple of percent against the dollar. Some in the market were actually accusing the BOE of bottling it, to quote them. Now, I guess to be fair, it was never actually a done deal in the sense that if we go back to the September MPC, then we had unanimous 9-0 vote in favour of no change. But crucially, I mean, the bank did seem to be deliberately talking up tightening prospects. Let me just go back to late October time. I'll just quote what Andrew Bailey, the governor, was saying. To quote, monetary policy will have to act and must do so if we see a risk, particularly to medium-term inflation and to medium-term inflation expectations. And that's why we at the Bank of England have signalled, and this is another such signal, that we will have to act. Now, when that came out, as far as financial markets were concerned, well, that's it. They're definitely looking to hike interest rates come last Thursday. And of course, nothing happened. So I guess, the question now becomes, why did they not hike? I think probably there's a couple of things involved in this. One, it really tells you that it's perhaps to some extent currently more than inflation. It's the labour market that the MPC is still concentrating upon. The furlough programme over here, so the job support programme, that ended in September. And it turns out there were many more workers still being supported by that scheme than the MPC actually expected. So it looks as if they want more time to assess just what's going to happen to the market, as this fiscal support has disappeared. Also, I might ask Terry how the FOMC deal with this once I've finished my little bit going on here. Uncertainty over the volatility of energy prices. Now, the way the MPC works, it puts forward its own forecast of inflation, and the current conditioning assumptions for oil, gas, and electricity prices, they're based on their respective futures curves, but only for the first 6 months of the projection. Beyond that, the bank takes a neutral assumption that they'll just be simply flat. Now, they also put out an alternative scenario under which energy prices would follow the futures curves over the projection period. And that would have left inflation, 0.5 percentage points lower than in the MPC's central projection a couple of years' time, and 0.2 percentage points lower in 3 years' time. So it does seem to me that it may well be the case that, to come out and introduce the tightening now based on such a highly uncertain forecast could be risky and ultimately lead to a premature tightening of policy. Now, that said, from everything which has been said around the meeting and indeed the Bank of England's press conference afterward, it does still look as if it's going to be a timing issue. For a start, the new forecast the bank put out last Thursday shows the CPI inflation at 1.9% in 3 years on the basis of market implied rates. And by that, we're talking about an assumption of a 1% bank rate by the end of 2022. So that'll be up, 90 basis points from where we stand at the moment. So essentially, it suggests that the forward curve is just marginally too aggressive in what it's assuming about tightening, because inflation is expected to be below the 2% target by the end of the period. However, the bank also shows what it expects to happen on the basis of unchanged interest rates, so the 0.1% bank rate, and that would leave CPI inflation well above target until at least into 2025. So in other words, policy just on the basis of the bank's own forecasts will have to be tightened at some point. Now, it may be the case that the bank will decide to pull the trigger at its next meeting, the last one of the year, on the 16th of December. But I think what we can say now is that UK markets will probably be that much more volatile around that date than it might have been otherwise, even if the bank does hint about a hike, as investors now simply don't know whether to believe it or not. Now, just quickly swing back to Terry. Terry, in terms of the Fed's forecast, I mentioned as far as the Bank of England's one, particularly this time round, the assumptions about energy prices have clearly been important in how they view what they should be doing with interest rates. How do Fed sort of look at what's happening to the energy prices, commodity prices, those things which are often very volatile, particularly these days when they're putting their forecasts and ultimately their decision making together?
Well, I think they like to avoid making too much of a forecast about the near term because these can be quite volatile. What they prefer to do is focus on the medium to long term in these things, on the assumption that this evens out over time. So they definitely expect inflation to be higher than it has been next year, but something near their longer run expectation of about 2% in 2 years.
Okay, fair enough. Thanks for that. Okay, just quickly back to my side then. I guess there's not too much else to say about the UK at the moment, bar we get the GDP numbers out on Thursday. This will be our first look at the third quarter. They're expected to show a quarter-on-quarter increase in total output of 1.5%. That'll be down from 5.5% in the second quarter because we've still got the unravelling of COVID, etc., at the moment. The main thing to say about that, though, that compares with the Bank of England's original forecast of up to 3%. They trimmed that to 2.5% at the last meeting. But again, it just does highlight the factors we've talked about before. The real economy in the UK at the moment is struggling a little bit. And with COVID numbers having been rising recently, there are concerns about how the fourth quarter's going to come in. And with regards to COVID, let's move across to continental Europe and the ECB. I guess really one of the media-grabbing highlights of this week has been, unfortunately, the rise in new COVID cases. They're now at their highest levels across the European Union since the middle of April. They're up around about 50% or so just over the latest month, and hospital admissions have also more than doubled over the last week. Germany's at new record highs, and as the World Health Organization are pointing out, Europe now is back at the epicenter of the pandemic. Now, it's clearly going to be important in terms of the growth outlook. The ECB has regularly quoted the downside risks stemming from the prolonged COVID crisis on GDP and demand and everything else. So I guess it's got to be one reason for, understanding why at this stage the ECB is refusing resolutely to be budged from its contention that the rise in inflation will be only temporary, because the fundamental picture really doesn't suggest it's going to stay that way. Nonetheless, in terms of what figures we have out from the Eurozone this week, and it's a relatively limited supply, they're unlikely to make the central bank's life any easier. We know from last week that on the whole, consumer demand across the Eurozone isn't doing too badly. September retail sales actually fell. They were down 0.3% on the month in volume terms, but the fall there was more than offset by a fairly sharp upward revision to the August numbers. And put a straight line through this little lot, by and large, retail sales volumes are still expanding at a relatively healthy rate. However, as again we've often talked about on this podcast, from particularly the manufacturing side of the economy, that's still struggling quite badly. We'll get the industrial production data for the Eurozone for September on Friday. They're expected to be down about 0.6% on the month. If correct, that would be a second successive fall. And that follows, quite surprising announcements out of Germany, where we had output down over 1% on the month, and France was even down 1.3%. So net that little lot together, and it means that the gap we currently have between demand and output growth looks like it's going to continue to widen, which ultimately, of course, is simply going to add to further pressure on pipeline prices and ultimately inflation itself. So whether or not the ECB is going to be able to stay with its view, look, we're not going to put up interest rates because inflation is going to come back to its ECB 2% target rate sooner rather than later, remains to be seen. But it's going to be a difficult time, I think, for the ECB, with the board clearly split between the hawks, who are really getting concerned now about the way inflation pressures are building, and those hawks are very much more worried about the way the real economy might be starting to slow down a little bit. Before I finish on Euro, I just want to mention a little bit of politics, because it could have major implications. We have touched upon it briefly before, and that's the war of words between the Polish government and the EU, particularly the EU Commission, and ultimately hence the risk of what's being termed this Pole exit, whereby Poland will actually leave the European Union. They continue to intensify, and the EU still insists that it rather than the Polish judiciary has the final say in Polish laws, and that is something which the Poles refuse to accept with a vengeance. At risk is the 36 billion euros of rescue funds which Poland was hoping to get via the new rescue program from the EU Commission. If that's going to be held back, the Polish government now is warning that it could suspend its EU membership fees. Now, this bust-up looks unlikely to end anytime soon. Indeed, it seems to be becoming more heated. And ultimately, you've got to think that Euro investors are going to start becoming increasingly alarmed as this fight drags on, because there's no obvious solution. And if indeed we can't get some kind of settlement here, there's going to be a real chance that Poland could be the second country to leave the European Union. They're not part of the Eurozone by any means, but it would start to unravel the union as a whole. And clearly, speculators can start looking around at prospective countries, perhaps some more high-yielding countries like Greece or Italy, perhaps with the view that they might actually want to pull out of the Eurozone as well. So it's certainly something to keep an eye on, not necessarily quite so much now, but say just from the way this euro is performing currently, there are signs that investors are starting to get a little bit alarmed about it. So do keep an eye on it. Okay, then, I think that's probably enough from me and Terry today. So let's wrap it up there then. I guess we can say that, markets now just simply pay so much attention to anything and everything that the central banks say that, as the Bank of England discovered last week, it becomes very easy to accidentally point investors in the wrong direction. Still, at the end of the day, policy is determined by the economic data. And on that front, you can always keep up to date with all the key statistics and events in Econoday's global economic calendar. I'm Arthur, Terry, and myself. Thanks as ever for listening. The podcast will be back again next week, and we hope you can join us then. Bye for now. Strategic investing and analysis are a lot easier when you can identify patterns and see how economic events and announcements correlate with specific market movements. The Econoday Investors Journal provides a convenient and easy way to follow important economic events every day, every month throughout the year. View the most important market-moving events for the upcoming year in a glance. The Econoday Investors Journal is your essential desktop resource for economic events and indicators, FOMC meetings and announcements, US banking holidays, equity settlement dates, and more. The Econoday Investors Journal is much more than a financial calendar. It's an indispensable tool to help you anticipate active days in the market. Learn the intricacies and interactions of the market, record daily market activity, and explore helpful insights from experienced market analysts. Take advantage of our informative resource centre, which includes a comprehensive glossary of need-to-know terms, clear, concise information on policy and historical trends, useful graphs, and a guide to the influencing factors and people to watch at the Federal Reserve. Order your 2022 Econoday Investors Journal now at shop.econoday.com.